Good afternoon, everyone. This is Nikhil from Zerodha, and today we have Mr. Ashwin Patni with us from Access EMC. Ashwin will be talking about these enhanced arbitrage funds, and he's currently actually the head of products at Access, and he's also the fund manager for their enhanced arbitrage fund and their Access hybrid funds, right? So he'll be talking to us about dynamic equity mutual funds, wherein the portfolio division between different kinds of asset classes is uh, distributed based on the current market conditions. Quite an interesting product for all of us. We can probably get started. Over to you, Ashwin.
Uh, Thanks for the introduction and hello everyone. As mentioned, the idea with today's conversation is to talk about dynamic products as a category, and within that, there is a thought process that we have done at Axis, with which we have launched the Axis Dynamic Equity product. With we can get share some of the learnings that has come in terms of how dynamic products are approached typically from that as well. So let's get started. What is the normal challenge for investors when they are investing? And let's take the example, let's focus on the equity markets in this discussion. So if you are looking to invest in equity markets, what happens when you're looking to invest? And the normal challenge is that as an investor you have to there are so many there's such an overload of information, data, messaging all around you, whether it is from the media, TV, newspapers. It is the talk that you will get from friends and family. There are lots of advisors, whether it is the banks, the brokers, the financial advisors. So essentially, in today's day and age, and of course, I'm not even mentioned the internet, social media, and all that as well. So in today's day and age, there is a lot of, you can almost say, information overload which is there, and that is the in effect, it's a good thing, because for a person who can sift through that information to understand what is going on. But for many of the investors for whom equity markets is not a very something that they are day to day involved in, and it is more a sort of passing acquaintance, it becomes really challenging to understand what is the noise and what is the information that they should look at. And that really is a big part of the problem of why people get so confused, or whether they get so uncertain when it comes to investing in equity markets. What is what does not help is the fact that the market is also obviously quite volatile. So when all the news flow that happens gets compounded by the market movements, which tends to be cyclical. So you have some good years, some bad years. In the good years, the markets give good returns. In the bad years, the market may fall. In some cases, they may fall even very sharply. And typically, the way the media, the people around us, they will react to these events, it sort of compounds the effect of what the cycle is doing. And that, once again, to the original point, plays on investors' minds when they are deciding how to act, or how to make their allocations for equity markets. So this, in fact, is the chart that we want to really sort of highlight. We have done this analysis of how flows into equity mutual funds have changed over a period of time. And the zero line represents zero flows. And so if the blue line is the flows line, and so if blue line is above zero, that means that is a period when money has come into equity funds from investors. The blue line being close to zero or below zero means that either flows are not coming, or at the margin, people are taking money out of the funds. So what is happening in this is, it's very interesting, is that because of the earlier point that we were making, which is that the market is cyclical and there is a lot of noise which compounds this cyclicality. When the market is doing well, there is a lot of hoopla, noise, positivity that is thrown up at investors, and that gives them a lot of confidence that equities can do well. We should look at allocating and investing, and therefore typically these are times when allocations flows into equity products go up. We have seen this in a number of cycles. In the chart, you can see the 2006-7 phase, or you can see the more recent last two couple of years, 2015-16 phase, as representative of this. Um, the On the other hand, if the markets are going through a tough phase or going through a sharp correction or they are being sideways, there's a lot of negativity which happens. And once again, the same investors who had that confidence that during good markets that they should allocate to equity start getting confused when they start seeing the market fall, when people talk up the negativity, when people say that there are issues around us, and either they stop investing or they get worried and they start redeeming from the investments that they have made. So this is the eternal challenge of investing in equity markets, and this is the big reason why, if you look at bulk of the investors, they have struggled to participate in the wealth that has got generated by equity markets over the long term. And the interesting thing is that this is not something that is limited to the Indian investor or the Indian markets. The nature of equity markets tends to be similar. So therefore, even if you study other markets, it has been seen that a similar sort of cycles, whether it is the boom bust, you call it greed and fear, or you call it up and down, similar cycles happen in host of other equity markets as well, and that is whether it affects those respective investors as well. What is the impact of these things? There is a very real material impact to the investors of getting swayed by market cycles, leading to their adjustment or reduction in allocations or variation in allocations that they have done. This is again a study that we have done at Axis AMC on this chart. What we have done is we have looked at what is the average return or the average performance of equity mutual funds over a period of time. The period we have taken is 2003 to 2016, so that's about a 13-14 year period. And what we see is that the average return over this long period is quite a satisfactory or quite a good number of 22% as the average number by across all equity mutual funds put together. However, the concerning thing is that if you look at what the investors have got, and how we have seen is by adjusting the return by the flows, when the flows have come in and out of the funds. That is the orange bar. If you look at the return that the investor has got, that is lower by almost 6%, at 15.6%. Now 6 doesn't sound much until you think that the difference in compounding, what does it lead to? In 22% compounding, 1 lakh has become 13.4 lakhs. With 15% compounding, 1 lakh becomes only 6.6 lakhs. So close to half the gain of the 22% compounding as an opportunity cost has gotten away when the number has gone from 22 to 15. So this is, in a sense, is the background, the reason why investors, we feel, need hand-holding, they need help, they need support, guidance in terms of managing their equity investment across cycles. And that help can come in number of ways. One is by educating them, by taking them through small experiences, trying to get them to make regular investments. A number of tools are there available. But all of them suffer from the same problem, which is that they are not able to handle a scenario where markets, if they go through sharp correction and investor is experiencing that correction in his portfolio, then they tend to panic. And how do you handle a situation like that? So one of the solutions that is possible, which can help investor in a scenario like this, is to look at a category called dynamic equity products. What are dynamic equity products? As the name suggests, these are products which are investing in equities, but in a dynamic manner, meaning that unlike regular equity funds, which may remain invested close to 100% or in that region throughout different time periods, a dynamic product has the ability or the leeway to adjust its equity allocation across different time periods in a manner linked to some approach or model or philosophy that decides how to make that change. So dynamic funds, like I mentioned, are similar to equity funds and different from equity funds. Why are they similar? Because they are also investing in equity markets to a certain extent. They also have active portfolios to that extent. And the difference is that unlike equity funds, which are fully invested in equities or close to fully invested across all time periods, dynamic funds actually keep adjusting their allocation linked to different variables in the market. What are these variables that dynamic funds look at? And different funds look at different variables. One of the most popular variables and one of the most powerful variables that is looked at is the valuation of the market, which can be seen through a simple variable called the price earnings ratio. Valuation is the most important or the most significant way of tracking what is happening in the equity market. What we have seen historically, and this is the chart that we have on the slide also, is that there is a very strong relationship between the valuation of the equity market and its prospective returns. What it means is that when if you invest at a high valuation, when the market is at a high valuation, your prospective returns are lower as compared to when you invest in a lower valuation, your prospective returns are higher. This is the same data that we've put up in a table format on the slide as well. So basically, to back to the point about dynamic funds are not that the way they run is not that they have a fund manager who in his whims and fancies or in his based on his subjective criteria decides what is the appropriate allocation for markets. They look at some specific parameters which affect the market in different time periods and try to create systematic rules to decide what should be the different exposure for different time periods. And as I mentioned, one of such criteria is the valuation. And as we saw, valuation has a very good relationship between prospective returns. So what a model dynamic product will do is that it will look at that a product that is looking at valuation is that it will adjust its allocation such that it is more allocated to equities when the valuation is low, or it can be higher allocated to equities when the valuation is it is have more allocation to equities when the valuation is low, and will reduce allocation to equities when the valuation starts getting higher. So these are the ways in which different dynamic funds can work. Uh, you could have other variables as well. At Axis, we look at a composite of 3 variables. Valuation is one of them. We also look at the trend of the market and risk of the market. But essentially, what dynamic funds stand for is adjusting the exposure or the risk of the market for different time periods, such that overall experience that investors get is one of lower risk and lower drawdowns as compared to pure equity products. And that is where many of the investors who get concerned with the market ups and downs, they they will find that dynamic products can be of great help or great value to them. Of course, as with equity products, even with dynamic products, these funds typically work over a cycle, so they should be seen as long-term products by investors, whether it is 3 to 5 years or longer. Typically, they work best when you invest in them with a longer horizon over a cycle. So with that, let me pause, and we can take some of the questions which normally come about dynamic funds. Um, I think one of the questions that we get a lot is what is the uh, uh, um, way in which dynamic management happens? Do you keep buying or selling the stocks, or what do you do? Uh, let me just explain with the example of our fund, which is the Axis Dynamic Equity Fund. What happens is that the model is run on a periodic basis. In our case, that frequency is once in about 2 months. And once the model is run, every time the model is run, it throws up what the appropriate allocation should be. And if the allocation has gone up, we have to add to our equity exposure. It has gone down, we have to reduce our equity exposure. Depending on what the exposure is, some of that can be done in cash equity. In some cases, it can be done through derivatives as well. Especially, I think derivatives becomes relevant if the model is making us reduce exposure below 65%, in which case that means that while we may not reduce our cash equity positions, we may choose to hedge using derivatives such that our net exposure is brought down without affecting our gross equity exposure. Why is that important? Because 65% and above gross equity exposure classifies you as an equity product from a tax perspective. So that hopefully answers the question in terms of how this happens. The second question is that how is the equity portfolio of dynamic products managed? And is the model have a role to play in that? And the answer to that is model typically for dynamic products is limited to the input of the model is limited to coming up with the appropriate equity allocation. So in case of, for example, the Axis product, the allocation range that model can throw up is anywhere between 30% to 100%. Once the model has done that, every time it is run, whatever frequency we run it at, once the model has thrown that number, then the fund manager does have a free hand in terms of the individual stocks or the portfolio, that how it is, how the fund manager carries out the portfolio construction, as long as the fund manager is able to achieve that target equity percentage that the model has thrown up. So effectively, the model, there are basically these products then operate at two levels. The model's role is limited to coming up with the appropriate equity exposure, which is sort of like a risk exposure, you can say, because whether the risk level is at a lower level, a lower equity effectively is a lower risk level, higher equity is effectively a higher risk level. So model does that part, which is first part, and the second part is done by the fund manager in terms of arriving at the appropriate stocks and constructing the portfolio for whatever the allocation is. The third question is that how has been the experience of dynamic strategies? Do we have any data about it? We can talk about the Access product. While it is a new launch for us, so we are launching that product this month. But as a because this is a quantitative model, we do have some backtest done of these products over the last 16-17 years, which allows us to look at how these products can work. What we have seen when we look at the data of our backtest is that dynamic products typically have done quite reasonably as compared to equity-oriented strategies or as compared to their benchmark, which could be any equity or balance kind of benchmark. But that performance in terms of has to be understood in 2-3 ways. One is while the returns are in what they are, the risk is substantially lower because of the dynamic management, and that is the key value addition that these strategies provide. Not only is risk measured as a volatility lower, but even any other ways of looking at risk, whether it is downside, drawdown, they're all substantially lower. Second observation in terms of performance is that these funds have typically worked well, as I mentioned even earlier, in a cycle. What I mean is that in the short term, you could have a situation where, for example, if the markets are doing really well, a dynamic fund will definitely trail the market, because the dynamic funds typically run allocations which could be anywhere from a lower number to 100, but uh, a lot of times will be below 100, and therefore it will be trailing the market if the market is going up very sharply. But a lot of times the same feature, dynamic feature, helps reduce the risk or drawdown when markets correct. So in the short term, you could have a situation where, depending on whether the markets are doing very well or not, the experience could be different. But over a cycle, when I say a cycle, anywhere up to 3 to 5 years, which has some good periods and a bad periods, when you look at adjusted for that cycle, which has good and bad periods, these funds end up looking reasonable, because by reducing some of these drawdowns, they are able to recoup in terms of their overall performance quite well. So that is essentially, I hope, these are some of the key points that I wanted to cover. I hope this is useful for everyone. Let me just summarize once again. uh, Investors, whether they are new investors, existing investors, any type of investors, most investors are don't find investing in equity markets very easy or comforting, uh, because of the fact that there are sharp market cycles and because of the noise around us. It does put off investors. While the going is good, there is no problem. Like last couple of years, we've had a great ride, but when the going gets tough, the markets fall, the negativity, everything else takes over. We have repeatedly seen episodes when market corrects. People who are happy to buy at higher levels actually stop buying or stop investing when the market is corrected and is available at a much lower level. This is a classical problem which is not usual, or not something which is only something we have seen in India. It is a very common problem, and the way these they can be this problem can be tackled. One very powerful way of doing that is the category called the dynamic equity products. Axis is launching a product in this month with the Axis Dynamic Equity Fund. And the power of the dynamic products is that by using a systematic rules based approach, they can adjust their equity exposure over different times in the market cycle, and therefore they can bring down the overall risk that the investor experiences of pure equity product. Compared to that, these dynamic products can deliver a much lower risk level. So with that, thank you everyone. Um, I will just introduce some of the other slides very quickly, but I will just encourage people to look at that quickly. The slides just give some details of the Axis Dynamic Equity Fund and the model that we have used, and as well as how the backtest experience has been for this in different time periods. Um, like I said, the key value addition is essentially in terms of the way the model is able to bring down risk over a cycle. Thanks everyone. Thank you for joining us today.
Yeah, hey everyone. So that was quite an interesting talk by Ashwin. So also always keep in mind that mutual fund investments are subject to market risks, and you are advised to read all offer documents carefully before investing. Right? Ashwin, anything else you would like to add here?
No, I think essentially, it's important for people to consider allocating to equity. It's a great asset class which has given fantastic returns over the long term, and so these are all different ways in which we can make it easier for people to take that decision. Because the worst option is if we allow the complexity to put us off from making a decision of investing in equities. Then it's a big shame, because that is a cost, real cost, that investor is bearing in terms of missing out on the long-term wealth generation potential of equities. And
Uh,
these are all ways in which we are making it hopefully easier for investors to take that decision.
all right, makes sense. Thank you, Ashwin. So that's all for today, guys. Ashwin, thank you for joining us. We hope to be doing a lot more of these in the future, right?
Great. Thank you so much. Thanks for having us today.